The United States has recently reached a national debt of $31 trillion. The question arises, is this something to worry about, and will this affect you in the long run? Hello and welcome to Eminent Investments. Today we'll look at Jim Rickards' crash prediction, which he claims will have a massive impact. That seems like intriguing news, so be sure to stick with us till the end of this video. Before we start, give us a like and subscribe to the channel. If you're done with that, then let's get right into it. Jim Rickards, a famous investor, believes that one should focus on the GDP ratio when talking about debt. Using the United States as an example, he adds that one should consider the country's ability to repay that debt. You simply can't discuss debt by itself without considering this aspect. Let's say, for example, that you have a $50,000 balance on your credit card. However, if your annual income is just $30,000, it's highly likely that you will struggle financially or even end up bankrupt. If you have a $50,000 credit card debt but your annual income is $5 million, repaying it isn't a problem. However, determining whether a $50,000 debt is a problem or not heavily depends on how it compares to your annual income. Obviously, if your income is significantly smaller than the debt, then it's definitely a problem. This makes the debt to GDP ratio a useful metric in evaluating the impact of debt on a country's economy. The United States has recently reached a national debt of $31 trillion, with the majority of this debt in the form of US Treasury securities. While there are other obligations, Treasury securities make up the bulk of it. The question arises, is this a problem or not? One way to assess this issue is by comparing it to the GDP. We must simply do the ratio. Right now, that ratio is above 130%. It was 106% at the start of Trump's administration. Trump, together with Biden, has taken about 25 percentage points. This is from 106% to 131%. With this, Rickard asks, what is the pivotal point at which water transforms into ice, or experiences a drastic change, shifting rapidly and significantly? The answer is 90%. When your debt to GDP ratio exceeds 90%, the multiplier for more debt drops to 1. To provide some context, at a 30% ratio, if you borrow $1 and spend it, you expect a return of $1.30 in terms of economic growth, assuming that you wisely spent it. However, as the ratio gets closer to 90%, that return diminishes. It may drop to $1.20, $1.10, or even just $1.05 for each borrowed dollar spent. Once you cross the 90% threshold, you might only receive 95 cents of growth for each dollar borrowed in terms of GDP, signaling that you're not getting the full amount of your dollar back. This strictly proves that 90% is the limit. The United States currently has a debt to GDP ratio of 131%, making it the highest one yet. This means that we have exceeded the point where borrowing more money can cultivate economic growth or assist in resolving a debt crisis. In fact, we're headed toward a severe debt crisis right now. To put it in perspective, some nations are in a similar situation. You'll find that countries like Lebanon, Greece, and Italy are in a tough financial position as the United States. However, Stephanie Kelton, the person behind the modern monetary theory, argues that the level of national debt doesn't matter. Critics often point to Japan as an example, since Japan's debt to GDP ratio is exceptionally high, at 280%. China, on the other hand, likely has an even higher ratio, but it's hard to confirm as they have a complex financial system. Although China's national debt may seem modest, there are significant amounts of provincial debt and state-owned enterprise debt. Plus, the banking system is controlled by the government. All these components factored together explain that the actual national debt in China is much larger. Stephanie Kelton says that you can simply borrow your own currency. For instance, if a country like Argentina borrows in dollars, but then tries to repay it by printing in peso, its own currency, they are bound to face challenges. This is because paying back a foreign debt in local currency requires substantial trade surpluses, which Argentina lacks. As a result, Argentina has a history of repeatedly defaulting on its debt obligations. Borrowing in dollars and printing in dollars is not as easy as it seems. Although it's true that there is no reason to default on dollars when you print it, there are still some bad possibilities linked to it. There are issues like inflation, hyperinflation, and the collapse of foreign exchange rates. Rickards stresses how modern monetary theorists like Kelton shed very little comprehension on the international details. The United States is not a closed economy, which most people assume it is. It still has to concern itself with trade deficits, capital flows, exchange rates, foreign credit, and trade surpluses. Kelton said that there is no need for a bond market because it only exists for bond investors to store their money. She, along with other investors, further adds that taxes should increase when inflation happens, and that there isn't even a need for a tax system. If we're just going to print money, then why should we have taxes? Some would answer that it's still necessary as income needs to be redistributed, which sounds a bit like a socialist model according to Rickards. If you were to inquire with the average member of Congress about modern monetary theory, they would likely be confused. Many of them have either never encountered MMT or lack a clear understanding of its principles. Whether they are aware of MMT or not, it doesn't really matter. Let's revisit the COVID-19 pandemic and its impact on the debt-to-GDP ratio. During the Trump administration, there was a $2 trillion COVID relief package. This package included the $800 billion Paycheck Protection Program and $1,200 stimulus checks. Towards the end of Trump's term, an additional almost $1 trillion package was approved, which included $600 stimulus checks. These checks are often referred to as helicopter money. Rickards thinks that the FED is incompetent for this, but helicopter money, which is fiscal money, is a recipe for inflation. Upon assuming office in January 2021, President Biden introduced his own COVID relief package, amounting to another $2 trillion. This included $1,400 stimulus checks. Subsequently, a $1 trillion infrastructure package was proposed in the same year. Finally, a recent addition to these initiatives was the nearly $1 trillion Green New Deal, which Rickards calls the Green New Scam. Now, the baseline budget is $2 trillion per year. However, calculating everything that has been spent amounts to $7 trillion, which is way above the baseline budget deficit. This amounts to an additional $9 trillion added to the national debt, which was approximately $21 trillion at the time, resulting in a total $30 trillion. This increase in debt caused the debt-to-GDP ratio to rise from 106% to 131%. These figures are staggering, and while proponents of the MMT argue that it's not a cause for concern, it actually is. As previously stated, it has a major effect on economic growth. In the best-case scenario, the United States can expect sluggish economic growth, similar to what was experienced from 2009 to 2019. In the worst-case scenario, if a recession is layered on top of this situation, the US could face severe fiscal challenges. Rickards also talks about the groundbreaking development that emerged in 1989 in the field of supply chain science. This field represents a fusion of various elements, including algorithms, applied mathematics, enhanced computing capabilities, linear programming, and other techniques. These components collectively enabled the expansion and elongation of supply chains to a degree that had never been achieved before. These advancements were motivated by cost reduction strategies. However, this also introduced hidden costs by making supply chains more fragile and less resilient. When one link in the chain breaks, it can destroy the entire system. Efficiency-driven strategies have created a situation where, in the name of cost reduction, we've introduced fragility into the system. Now, as these systems crumble, it will take a huge amount of effort of 5 to 10 years or more to rebuild and reorganize these supply chains. This situation may lead to the formation of what Rickards refers to as college of nations among countries, where supply chains become more like a club. To become part of it, you have to be a democratic and liberal society, both in political and philosophical terms. Well, that's about it for today's video. If you liked our content, do give us a like and subscribe to the channel. Once again, this is Eminent Investments. Thank you for watching, and we'll see you next time.